Hello, everyone. Welcome to the weekly roundup. Today we will cover interest rates, economic growth, and tariffs. Hello, Ben.
Hey, Eva.
Welcome back.
Thank you. Yes, had a week off, a little rest and relaxation, and ready back in the flow.
Great, great, awesome. So let's get right into it. There's a lot to cover this week, so we would try as much as possible to keep it within our time frame. We're going to start off with global interest rates. The Bank of Canada held its policy rate steady. The Feds also left the benchmark rates unchanged, but the Bank of England narrowly voted to cut. I mean, with only three Fed meetings left this year and two rate cut projections, is a September cut plausible? And are we seeing a move back to cuts globally?
Yeah, it's a great question. I mean, I think that the US particularly has been trying to figure out what to do with interest rates because of the tariff and trades war that's going on. Started in the US, and so that's put pressure on inflation numbers. And so that's really put the Fed on pause. And so let me just answer that one probably first. We still think that rates come down in the US. The employment number came out was actually worse than expected, revision to the downsides, some talk about tampering with the numbers, which is always the case, but continues to be the case. So the unemployment rate's rising in the US. I think that's the one thing that the central bank will be worried about. And so we still think rates come down there. And in Canada, we think rates come down too. And as to your point, is September when they start? I think the answer is yes, that we should see something in September. August is a quieter month in the markets in the world in general, typically. So we'll see what happens there. Bank of England, to your point, cut. The economy's slowing, unemployment's rising there, inflation's not as much as a concern there as it was maybe 6 months ago when they decided to go back on hold. And so, yeah, I think we see rates continue to come down. And our view still is 75 in Canada and 50 in the US.
Okay. Speaking on the jobs report, it came in weaker than expected, and this is fueling concerns that the US economy is slowing. Um, what are your thoughts on this?
Yeah, I think it's the case. And there's lots of people moving around the US. Obviously, they're doing a lot of closing of the borders has certainly happened, and so that's having an impact. You're seeing layoffs starting to happen in a lot of different areas, including tech, and some of that's driven by AI. And we saw a number of companies, including IBM, reduce their HR headcount materially, something like 90% of what they had. And a lot of that has to do with AI supporting that part of the business. So I think that unemployment's a risk and the economy's slowing. But I think the big question is that I get from people is why doesn't the market carry it? And so that's something that causes quite a bit of concern for me right now.
Okay. Tariffs. So President Trump's new tariff regime just kicked in. How does this affect trade with Canada and global supply chains?
I got to think it materially affects both of those things, Canada and global supply chains. And I think that it is probably, well, at least for the next 3 years, has materially impacted the trust that people have with the US. And so there was really, I think, a bigger comfort with the view that, okay, we will work together, we trust you, we put an agreement in place, and we trust that agreement stays in place for a period of time. But I think trust has been eroded quite quickly. And so, you can't really be certain what the rules are if the goalposts keep moving, and that's what it seems like, I think. As for Canada, I mean, they're doing their best to pivot away from the US, but you can't just do that overnight. And so you're seeing a big change there. Um, I I think it's having negative impacts on the US as well. And, when Trump puts policies in place that have an impact on farmers, for example, if you're not allowed to ship your soy to China anymore and you lose your whole market overnight, that has material knock-on effects and as a negative impact. So I think it continues to be something that we should be concerned about. I like as we look at it, it should be very inflationary, but it's not in the numbers right now. And so that leads me to believe that the underlying economy is a lot weaker than would be otherwise.
Okay, just some interesting news I came across this morning. President Trump is expected to sign an executive order allowing alternative assets like crypto, private equity, real estate into 401ks.
Mhm.
What are the implications of this in that market and generally for retirement planning?
So it's a big adjustment all at once. Obviously, with the real estate side of it, that would be Trump's baby, and that's the area and things that he knows best. And so, how is that going to play out? That's going to play out in time, I guess. As for the other asset classes, crypto, potentially stablecoin, blockchain, those kinds of things, that probably starting to signal the maturity of the asset class. Ultimately, probably brings down volatility, but also for me, tends to when you get these kind of big passing changes, occasionally that signals the top in a market. So it's something that caused me a bit of concern when we see that. Part of the reason why people like and are attracted to the interest in why 401k assets matter is because those are really the only US domiciled assets that have positive flow every day and every month. And so there's a bit of support into those asset classes because people put money in their 401k. It's typically business centered. You have to put X amount of your dollars into there. This is like that continual buyer. And so there's the thinking around why they're so material. So I think it's a general positive. The banks are still figuring out how to house the stable coins and such into their assets. And so that's probably level two for an impact in the asset class. But yeah, big change, and something that we'll continue to be conscious around the impacts. Me would tend to lean contrarian more and say maybe we're seeing a topping that we need to think about.
Okay. And my last question is, how is the market reacting to all of this colorful news?
Yeah, so I think as I wrote in my daily there the other day, obviously I put it in French, but the more things change, the more things stay the same. So I think that's the market's kind of interpretation of this, which is we don't care anymore. And so I went away for a week, and um, really not a lot changed. A lot changed, we'll say, economically, politically, tariffs, trade, a lot of change. The market, very little, some nuance changes. Microsoft Meta had really good earnings. The market tried to rip, like NASDAQ took off. Microsoft Meta took off, but NASDAQ finished down that day. This is a warning sign, something that we shouldn't be happy about. On the same day, we saw yields start to move in the other direction. So yields down, prices up in bonds. So a little bit nuanced changes within the market, still trying to push higher. Like Nvidia hit new high today. Some of the techs are still trying to push higher. Some of the companies that are meeting and beating expectations are pushing the market a bit higher. But the underlying kind of nuanced changes are starting to have me think about what we need to do. But big picture, market doesn't care. I think is what the answer is. We see all these new tariffs and trade come in place today. Market's up. It's a bit concerning to say that the world's kind of moved on and said, yeah, I guess this is something that we have to live with, and we just have to factor into our business plan to some extent, is what the market's interpreting. Underlying, to your point earlier, there's fractures, there's unemployment rising. There's some other things that we need to think about in the underlying, but the market so far has been quite resilient. And so that's giving me something to think about. What do we do? How do we prepare? And are we going to see a reacceleration, or do we kind of go sideways into waiting for something big in the world to happen again?
Good. Okay, let's go into the charts.
Okay, perfect. All right. Yeah. Let me know when it's all set.
All good.
Oh, good. Okay, perfect. So we're recording this on August 7th around 1 o'clock. So anything that happens between now and the end of the week, we'll comment on next week. So so far, so good. Quiet week, and we'll see what the next 24 hours leads. As we jump into things, let's take a look at one of the things we talked about, employment and employment numbers. Great chart just talks about we'll say the surplus of available labor contributes to wage moderation. So I think this is something we need to be conscious of is the unemployment rate, as we've mentioned, is kind of been going up here, a little bit sideways recently. One of the more concerning, I would say, material pieces is the hourly wage rate of permanent workers has been falling now for 18 months. So as you get interest rates going up in that backdrop, you get money in your pocket going down. That's when you start to have some material concerns. And so this is part of why our view is that rates come down, is because we think the Canadian economy is slowing, and we know that in the data. And the pace of which it's slowing, I think, is faster than the market's anticipating right now. And so if we see people making less money, we see unemployment rising, then we need to see something else, which is rates come down in order to allow Canadians to be able to continue to pay their bills and change and move houses and so on and so forth. So this is one of the data points that we think around why rates continue to come down at this point. Something that I alluded to a little bit earlier in our conversation, just about a lot of the changes happening in the U.S. is as I say, the borders have been closed. So this is net unauthorized immigration to the U.S. on the left-hand side here. Obviously, we've seen that go from a pretty material number down close to levels that we would have seen in the early 2000s. And so, whether you like it or hate it, this is a fact of what's happening right now. Weekly arrests by ICE, Immigration Customs Enforcement. Again, this number is exploding to the upside. So, it is something to think about because all of these things that are happening have knock-on effects for the U.S. economy. Good, bad, generally bad, as you have a negative drag that's happening in the U.S. economy right now. So the numbers are pretty material, and I think it's something we need to continue to think about. What are the knock-on effects of that? Always get this question, so I thought we would pop it up there. It's good to look at forecasts, again, whether you agree or disagree with them, just around the thinking of where we could go from these levels. And so on the left-hand side here, we have a National Bank forecast, market forecast for the TSX. Actual, this was as of the 16th of July, so 27,153 with a target of 26,700 by the end of this year, which kind of leans towards potentially lower levels for the market. A lot of this is driven by earnings and multiples. And so if you look at the multiples here right now, we got a 17.7 PE. So that's the price earnings multiple. This is the trailing. So this is the past 12 months. With expectations that the multiple contracts as earnings are falling. A lot of that has to do with what we're talking about with the economy slowing, earnings are falling by the companies, and so that has knock-on effects at this point. So if you look at the S&P levels here, which a lot of people tend to track, we're higher than this at this point now. So we're looking at a year-end target of 6,000. So that's a decent level lower from where we are today. And so again, PE trailing 25. Forecasted, so forward PE, which isn't on this slide, somewhere closer to 23. But just looking at the levels, we still think that that maybe is a bit of an optimistic perspective at this point. So in both cases, forecast by the National Bank is slightly lower on both indices. One of the points that I've tried to hammer home a little bit over the last 6, 9 months is just around the Chinese market, how it's been changing, and the economy at this point. And so we've seen a lot of things happen there. We've seen the housing market really come unglued, and effectively it is now stabilizing. And so Chinese real estate appears to be stabilizing, at least from the data. And one of the areas where I've thought there is material tailwinds that could happen as the Chinese economy really starts to kick in. And these are a couple of areas where we've seen employment index, the employment sentiment and expectation index. These numbers have been falling and appear to be bottoming at this point. And the income sentiment index and confidence also appear to be bottoming. And when they are below these levels, the people are worried and concerned, and I would say that the Chinese government certainly would be concerned at these levels as well. And so there is a lot of support that they can continue to do to stimulate the economy. We have the China's 5-year plan coming up in the fall. So I think this is setting up to something that we need to think about and be conscious of, is there could be a material tailwind that happens of the Chinese market and economy as we start to see some positive news come out of there. And as they try to stimulate, this could be reasonable from an investment perspective as well, and something that I continue to track. As always, the opinions expressed do not necessarily reflect those of National Bank Financial. If you have any questions, certainly feel free to reach out to me or your financial advisor, and we can comment on any of these ideas are appropriate for you or your situation.
Thank you, Ben.
Welcome.
So what's on the agenda for next week?
So I think one of the things that I try to watch into August typically has been volumes. And so I'd be watching volumes at this point and saying where and what happens, and what do we see from here. I would like to see what if there is any follow through from these earnings, because there have been some pretty big earnings releases with, as I mentioned, Microsoft and Meta had big earnings. There's still a lot of attention towards AI, and that momentum trade continues to be moving along. The focus on this Magnificent Seven has been driving and further concentrated positions. So I'd be watching to see how that plays through, what the volumes are like. But August tends to be quieter. And so that would be something I'd be thinking about. As I mentioned, I think 2 weeks ago now, because I wasn't here last week, was just around there's more things that I see out there to sell than to buy. And so I'd be spending a lot of time saying, are there any appropriate places to look for some profit taking, some switches, where and how we could do that to reposition for what's coming in the fall, which is, I think, quite a bit more volatility than we've seen the last couple of months. And so I'd be thinking about how to reposition some of the holdings right now.
Yeah, sounds good. Thank you, everyone. Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial heartbeats will be in the caption of this video, as well as in your inbox. For our clients, please reach out to me if you would like to book a review meeting with Ben. Thank you, everyone, for listening, and have a good weekend ahead. Bye.
Thanks, everybody. Bye.